Good morning, everyone. Welcome to Kiss My Assets, powered by Neighborhood Ventures. I am your host this morning, Kyle Macdonald, Investor Relations, alongside with Jameson Manwaring, CEO of Neighborhood Ventures. Here on Kiss My Assets, we take a deep dive into what's happening in the national real estate market as well as other local markets. A lot of the times our home Phoenix market, but there's so many things to analyze from interest rate economics to supply and demand. And here on Kiss My Assets, you get a full deep dive into things like that. And so today we're going to be covering several articles that we picked out from the Wall Street Journal and Business Article, and just talk about how that relates to the overall macro market, and then also kind of dive into some micro things in the multifamily industry, hospitality industry. But firstly, Business Insider reported this week that the mortgage buydown backfire has been hitting home buyers like crazy the last couple of years. Jameson, why don't you do a little high-level overview of what this was talking about?
Yeah, so if we think back over the last 5 years, so 2020, so 5 years ago, we were in the midst of the COVID pandemic, and as people were staying in their homes, realizing that they wanted more of a home than they were in, realizing they wanted to get out of the big cities that were really on strict lockdowns, people started moving, and home ownership and how people looked at their homes really started shifting. And we didn't know if this was going to be a long-term shift or a short-term shift. But they started, getting a little antsy sitting in their homes and looking on Zillow, and it ended up driving up the housing market in late 2020, 21, and into 22. We began seeing a rapid acceleration in values as we got to late 21. In markets like Phoenix, there were properties that had 40 offers on the first day and had to basically totally capitulate to the seller. I remember seeing articles where one family said they would name their child after the seller if they would accept their offer. So it was getting total chaos. And we all knew that was happening, but there's also something in investing called animal spirits. And that is, in a nutshell, how our emotions and broadly kind of the emotion of the group can take people in a certain direction. Mm-hmm. And that was what was happening in markets like Phoenix in 2020 and 2021. They didn't care. They said, I don't care that this home's gone up in value by 50% in the last 2 years. I still want to buy it because I don't know what I'm going to do if I don't get this home. Maybe I'll lose out, and maybe the values will keep going up. So I'm just going to buy it. So a lot of people bought there at that high peak of the market, and there was a lot of debate going into 2022. Then since that time, we've been in a Federal Reserve interest rate hike cycle, which is always bad for real estate because you use debt to leverage the purchase. So that's basically what's been going on the last 5 years. All this hype, then inflation came in, so the Fed raised interest rates, and we've basically been in kind of this weird, more stable market nationally. Each market is definitely different, but Phoenix in particular, values have stayed pretty steady, but it's become more of a buyer's market now, where there are fewer buyers, so the people who are out buying are tending to get a little bit better deal. And what we want to get into with this article and what this points out is folks who made that bet, purchased around that peak time frame, and did this mortgage buy down, betting that interest rates would come down later. And this is a great case study into what's happening with some of those folks.
Yeah, let's dive right into that. I mean, you're absolutely, and myself, I was actually one of those buyers 2022, 2023. I purchased a home June 2023, brand new build. And a lot of these developers and builders were offering this, what they call in this article, silver bullet for the development business, is this mortgage rate buy down. Let's talk more about that, what that is, what that has looked like for these home buyers, and kind of the pros and cons.
I want to come back to that. The other thing that multifamily operators and owners were kind of told, or was kind of the catchphrase, was survive till 25. So it was, hey, these rates are making things difficult. We also have a lot of new supply out there that's making it difficult. You're not able to raise rents, but get to 2025 and everything's going to be okay. And I liken that to what the new home builders were doing by saying, hey, buy the house. It's still a great house. Buy it at this basically the same level as what it was at the peak. And yeah, you can come in with an interest rate right now that's basically below market, where you're going to buy it down. It isn't a market rate. So anytime you're doing that, you're kind of playing a game there that you're making a bet. And for a homeowner who wants a new home, it's like, cool, these guys know what they're doing. They're the one advising us to do it. But then that rate expires. And if you still own the home and interest rates haven't come down, let's say you bought it, let's say rates were at 7.5 and you bought it down to, 5.5, 5 or 5.5. Now that makes your mortgage payment a lot lower.
Yeah.
Now, if interest rates are still 7.5, you can't refinance it. Your rate goes to 7.5 now.
Yeah.
And that mortgage payment bumps up.
Yeah, absolutely. And just to give like an example of myself, like when I bought a home in 2023, right around the peak, my interest rate was about 6.875, and I did a 2-1 buy down. And so bringing that down, 2 points the first year was really nice. And then 1 point the second year was great, but now it's 2025, myself having a mortgage on this home.
And now you're at the full 6.8 interest.
Now I'm back at the 6.875 interest, and, I'm having to face that reality as a homeowner. And, there are lots of stories here in this article, like Mr. Matt Hutton, where he bought a home in Denver, right? Prices were high, and these home builders didn't want to cut the prices of their homes. That's the last thing they want to do. And so this really was their silver bullet and kind of their one way out to avoid that, right?
Yeah, it was to keep things rolling. If you kind of look historically at economic patterns, things were hot, and then those builders, they got committed to some development. And so as they get to the end of that cycle, and before things start moving down, they get real creative in trying to keep that thing going until they're done with the project. Yeah, exactly. Now, some of the times it works out great because a homeowner can come in, the buyer, the builder gives you a bunch of incentives. Yep. Their lending arm loses money to get you in the deal. And then sometimes it doesn't work out. And I think one of the other things that was pointed out here is those folks now, if they go and put that home up back on the market today, that's going to be the big shock, because the price that they paid, they're going to be in a negative equity situation. And a lot of them kind of know it, but they don't know it. But they're going to find out if they put the home on the market. Now, that's not a good thing to do anyway. Anybody who owns property, whether it's their primary residence or other assets, you never want to get in a position where you have to put a property back on the market to sell it to survive. Like you have to say, I gotta be able to own this thing for 10 years, worst case scenario. But a lot of these folks probably weren't that sophisticated, or they're just going to be pretty upset as we go through this next cycle. They're not able to sell it for what they owe or what they purchased it for, and we're gonna start seeing some distress. We're gonna start seeing some foreclosures. We've started to see some more of those pick up, but that's part of what's going to be driving this cycle is those folks that came in those periods. And yeah, I mean, your mortgage goes up 10-15% each year. You talk about the 2-1 buy down. Year two in that probably went up 10%. Year 3 it went up another 10%. So 20% over 2 years is a pretty big bump.
Yeah, absolutely. And I think, my story is the story of many people. And, back in 2021, as operators, we could all see, commercial real estate and also single family residential real estate was really booming, and all the headlines were positive locally, nationally, and it seemed like a relatively great time, especially if you could get those lower rates to buy. But if you bought 2022, 23, we're seeing that especially on the multifamily side, right? A lot of the operators who bought 2022, 2023, we're seeing that distress. We're seeing those foreclosures.
Yeah, the best comparison for an apartment building and an apartment operator is what's called a rate cap. So and it's very similar. Let's say interest rates were 6.5%, but the deal doesn't work at 6.5%. So they're able to go do a rate cap, and a rate cap comes in and says, hey, we'll give you a 4.5%. And you just have to pay this fee, but they pay it on a monthly basis, or they pay it up front. And then on a monthly basis, that rate cap comes in and compensates for the higher interest level. But those things expire. So when they come to expire, you either have to put in more money to renew the rate cap, or you have to start paying the higher interest rate. But this is all part of the process of people trying to hold on to the cycle longer than they should have, instead of just say, hey, let's look at where things are at and let's take a market rate. And that's a lot more conservative, a lot more logical, because the folks out there who are pushing that were saying, survive till 25, things are going to get better. Now what they're saying is things will be great in 2028. So
there we go, folks.
3 years.
There we go.
If you can push things off 3 years, it seems like everything's going to be better. So important to know that how I think this impacts the broader single family market is some of these folks, they're not going to hold on. They're going to give these homes back. I don't think it's going to be broad-based, but we are going to see some at the fringes, and it's also an opportunity if you're an investor. Yeah. We've taken this opportunity with apartment buildings in several situations where folks had rate caps, they had loans coming due that were short-term loans, and we come in and buy those buildings. So that's the other side of this is, in a cyclical industry like ours, you have to be ready to be opportunistic on that side of it. Yeah,
absolutely. And let's talk a little bit about that before we move on to the next article. Like, do you think with this environment, with rate volatility and all this creative financing that's been happening for the last couple of years, that this strengthens the case for multifamily as a more stable asset class compared to maybe single family or other commercial real estate?
Multifamily can be a much more stable asset class, but it depends on how you're purchasing it and the type of financing that you're getting. If you're someone who goes in and purchases a building and said, hey, we can own this thing for a long time, we can cash flow, we can keep our debt low, then it's a very stable asset class. You just kind of let the property do its thing, and whatever the noise is on the outside doesn't matter because you're able to manage your property. And then you can make a good profit when the market is ready and right to sell it. Then you take it to market and you sell it. You sell a nice property that's performing well. If you have plans of a quick turnaround, I got to sell this building, I got to sell this house, it's a flip. If you have plans of, okay, our debt's coming due or else it's going to go up, that's when real estate becomes unstable. That's when it becomes volatile. So it doesn't really matter if it's a single family home or an apartment building. It really depends on how you structure the deal.
Yeah, absolutely. And a lot of investors, as you know, Jameson, are really excited about the end of, coming up on the end of Q3, going into Q4 of this year, what the Federal Reserve is going to do with regards to rate cuts. Could you just touch on that a little bit? What you think is going to happen, and what maybe is there light at the end of the tunnel for some of these people who, got in those peak years and have been experiencing that volatility?
Yeah, I think we're in the beginning of a rate decreasing cycle. We don't know how big that would be. The Fed has said that interest rates currently are elevated in a prohibitive way to try to slow down the economy. And in the last comments from Jay Powell, he's saying that's not really necessary today, so they likely will come down a bit. And then, we're going to have a new Fed president next year. We're going to go into a period economically where it looks like inflation is getting under control. That's the one. Interest rates are always tied to inflation. So
yes.
That's the main thing we have to look at. Inflation looks like it's coming out of control. The one factor there is, with all the new tariffs, will there be a period of inflation? Will it be a short-term period where it's like a one-time hit and then it levels out? That's one of the big debates, and that threw a little bit of a wrench in the mix. But the consensus is, and this is what I believe too, over the next couple of years, we're going to be in a rate decreasing environment. We're coming out of a rate increasing environment. We just don't know where that will settle, but that's a good thing for real estate.
Yeah, absolutely, and that's also good news for me, as an owner. And
and
all
as a
the
homeowner,
and all the other owners out there who've experienced this situation. Well, thanks, Jameson. This was an awesome article to deep dive into. Let's go ahead and move on to the next from Wall Street Journal. The title is, "Do you need to own a house? Many older Americans decide they do not." Now, given your forecast, maybe this title might change going forward. But this was a really interesting read, and has been kind of a common trend that we've been seeing across really, all ages and all walks of life, from millennials like myself to 55 and older. But what'd you think of this from the get-go?
This is more of a fundamental long-term trend that we are more than halfway into what people have called the silver tsunami, where baby boomers are retiring. And they are working a little longer than prior generations, but they are retiring. They're changing our economy because of what they do financially. And this article points to a trend that we identified, and it's part of our investment thesis, and that is, as people get older and the baby boomer generation does retire, they don't want to own these large homes anymore. Sometimes their kids don't want to take them back, and they want to go live in places that are kind of have stuff to do. They're cool. Yeah. So we're not talking about when people have to go into a retirement home. We're talking about people who are still young. We always had the 55 plus communities. Arizona's big for that. And that's still an option. But they also like to move downtown and go to a baseball game. They like to live near restaurants. They want to be, they want to ride the train. They want to be close to the airport so they can fly around the country and see their family. They've also seen that the cost of owning a home, because most of this group doesn't have leverage. Most of their homes either have low debt or no debt. But the cost to maintain their home has gone up. Insurance costs have gone up, and there's another way for them to live, and that is to simplify things and go rent. We are midway through this cycle. We think this cycle is going to continue. And this bit definitely benefits and is a driver in the multifamily industry. Got to remember, about 60% of the people who have housing, own their housing, and 40% rent their housing. And that, we think, is going to either stay the same or slightly increase on the renter side, where if you look back 20 years ago, it was more 65 and approaching 70% homeownership. This will continue to drive that that proportion that are renting, to keep that that portion of the demand really high for in the apartment buildings.
Yeah, and like you said, a lot of, so if you do read this Wall Street Journal article for our viewers, it talks a lot about people 55 and older, but even younger generations, you know, like Jameson and myself, it's like there's a lot of common trends as well with this. From my understanding in the market, there's never been this large of a gap between the cost to own a home and also the cost to rent, right?
Yeah, it's in our market, Phoenix, it's a 50% more expensive to own the home than if you go rent a property.
Unbelievable. So where's the incentive?
There is no incentive.
There's no incentive.
There's some tax incentives. There's some pride of ownership.
Yeah.
But let's say you're 55, 60.
Yeah.
You don't need that tax incentive anymore.
Of course.
In most cases, you don't have the pride of ownership. You've already owned a home. You already got that notch on your belt.
Yeah.
So renting makes a lot more sense financially.
Yeah, and also, you know, being multifamily operators, how does that change the game for us as far as how we design communities, how we attract tenants? Because with that, and with the multifamily boom, Phoenix being one of the top 3 markets in the country with new multifamily units coming online, how do you compete as a multifamily operator?
Well, the main driver and the main change here is that people want to have the same amenities if they're renting, if not more, than what they have in their home. So they want to be able to say, hey, honey, let's just go rent this place. They have a great pool. They have, the property is updated. We have a brand new kitchen. You have, great electronics inside, whether that be, having cameras or some home automation. And in many cases, you can go into a bit of a nicer neighborhood because of the disparity in renting versus owning. You can go spend a little bit more money and be in a nicer community than maybe what you're currently living in. And especially when you think about proximity to airports, to all of those exterior amenities. So the days are over where people will as an apartment owner, where you can just keep an old unit for 25 years and have no updates. Today, you can go spend some money, make the units updated, and rent them because people want those amenities. So that's a big shift that's happened over the last 15, 20 years as more people have started renting.
Yeah, so in essence, it's really, I mean, what you're talking about is, the competition has upped.
Absolutely.
Across the board. And, I love what you said about how you can no longer just buy a property or develop a property and do nothing to it for 25 years, because it's really just going to continue to, especially as an operator, show the strengths and weaknesses of an operator. And I think what's really great about Neighborhood Ventures is the true vertical integration of Neighborhood Ventures. Could you talk a little bit about that, how being truly vertically integrated is going to either help you win or, maybe not?
Yeah, you have, when we started out, we didn't do renovations in-house. We didn't do property management in-house. We didn't do maintenance in-house. We just started out with 3 or 4 of us. And we quickly learned the first one was renovations. We had outsourced our renovations to a well-known contractor, and they just totally screwed it up. Their costs came in higher. They had overruns. We said, we're not going to do that again. We actually took over the property, fired them, came in, and finished the renovations ourselves, hired our own team. And then with that team, we went for our next property and we built that renovation site in-house. And we haven't looked back since. That was 7 years ago. The second big part was bringing in the property management site in-house.
Yeah.
And it's one of those things, and I've never I like delegating. I like giving people authority. I like hiring great people, working with great people, and trusting them. With property management, it is really one of those things where if you want it done right, you have to do it yourself, because the third-party groups that you can work with, they are so spread out and their priorities are not aligned that unless you're going to overpay for that third-party management, they're not going to be able to do a great job for you. It's just the way that it is. So we brought that in-house, never looking back on that. You have to get to some level of scale. You can't do that if you just own one residence. But that has been a tremendous value to our firm. About 15% of our new residents come from referral because of how we work with our residents. By the way, we call them residents. We don't call them tenants, because this is where they live. This is their home, and we want to treat them accordingly. 15% of our new residents come from referral because their friends say, hey, this is a great place to live.
Yeah.
Across our properties, they may even say that that's a different property, but it's the same company. You should go live in one of Venture Residence's properties. And then the other part of it is the maintenance, because there's always things that are going to come up. And if maintenance is done poorly, if it's done, it was not responded to quickly, if there's a lot of out of order signs on a property, really bad sign, bad operator, stuff needs to get fixed immediately. And those folks need to be customer service oriented, right? So
absolutely,
if you want to be a great operator, that's what you have to do, and that's the kind of the price you have to pay. You got to do all of those things, not just buy the building.
Yeah, absolutely. And if you're an investor out there, I think that's one of the most important things that you can look for when you're looking to invest into a deal is who are the property managers of the asset. Jameson, you don't mind, I'd love to share a personal story. A couple of years ago, I was doing a capital raise for a multifamily development project, and we had a very sophisticated investor in our office who actually runs several experiential hospitality developments up in the state of Utah. And the first question this person asked us, they were considering a $500,000 investment into this development, was, who's your property management company?
Yeah.
And the two things you want to know is, one, is your property management company in-house?
Yeah.
And at the time, the answer was no. And then the second question was, well, if it's not in-house, how do you vet and verify and get to know that these property managers are who they say they are, right? And of course, you can look at track record for a property manager, you can look at all these things, but until you really work with them, and you could probably speak to this, you really just don't know how good they are.
Yeah, and unless you are willing to really pay up, so there are some great third-party property managers, but you have to really pay up and overpay.
Yeah.
You're paying for a lot of management on top of management on top of management. If you want just a great property manager at a great value, it's very difficult to find. You're better off doing it yourself. If you're a small operator and let's say you own under 100 units, you need to do it yourself. Maybe hire a college intern to help you out. But over and over again, you hear these stories because the good property managers, they're busy, they have no room, and the great ones are going to charge you more for it. And so it's something that's worth building out in-house. And so yeah, we kind of have these tailwinds in our industry where it's more affordable to rent today. We have more baby boomers deciding to rent than to buy, more younger folks waiting to buy later. So if you can do multifamily right over the next 10, 15, 20 years, you're going to build a great investment. You're going to have a great company. And that's how we try to do things. I definitely believe in this trend that we're going to see over the next period of time. And it's not a day trading. It's not a get rich quick. It's do things right, run the business the right way, be long-term minded, and we can do very well.
Well, Jameson, you answered my last question. I think you absolutely nailed that. And to our listeners out there, if you'd like to get to know more about our investment approach at Neighborhood Ventures and how we underwrite deals, but also forecast all these different variables when it comes to the multifamily market, feel free to reach out. It was great talking to you today, and these were phenomenal reads and phenomenal insights from you.